Alrighty. Hello, everyone, and welcome to today's market update and Q&As. I always get asked some Q&As, and I make a video about them. Today, we're going to get into the concentration of the S&P 500 and how it's affecting SPX options and all that jazz, and just how it changes the behavior of the SPX options. I recently wrote a blog about it, so a question got emailed to me, so we figured we'd just knock it out in this video. So without further ado, let's kind of dig into just where the market is, a general update, and then we'll get into that concentration effect. And then we'll also be digging into just kind of how the Sleep Well portfolio and how all that's going for all of you guys that are subscribed to one of those services, just as your weekly kind of update here. All right, so where are we in the grand scheme of things? Well, we've had this big, long uptrend that's been going on for a long amount of time. I've talked about this before. This is driven not necessarily fundamentally through economic growth, but it's driven fundamentally through monetary expansion. And that monetary expansion takes the form of the 2.4-ish trillion dollars that was in the reverse repo market. That has been slowly being drained into the financial markets. So it's creating asset inflation. So if you see this, right, you can see when the reverse repo market was stalling, and then it took off and kind of went into oblivion when it started to drain. And then when it started to go sideways, the market kind of comes down. And then when it drains again, it kind of pumps it back up. And then it went sideways, drains down, yet again, over. And then we've just gone to this constant draining, constant go, 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 with basically no stop ever shown. And it has gone straight up since then. And, makes sense, right? We pushed roughly let's see, from this point on, 1.48 trillion. You can see it over here on the left side of the graph here. 1.48 trillion, and we are now at about 507 billion. So roughly $1 trillion got pushed into financial markets, and this typically goes into treasuries. And of course, as you push money into treasuries, it's new money that wasn't there that's buying an asset, because the reverse repo market was kind of like a side piggy bank. Anyways, not going to get too much into that. I've talked about it on other videos, and we talk about it basically every week in the Adapt Advanced system. So as far as how other things or how this is going to transpire or where we're at, you can see that we've got a little bit of a tail uptick here recently. We'll see if that ends up turning into anything, but you are seeing definitely here, we'll kind of just draw on this a little bit. You are seeing this kind of roundingness that's kind of going on. I call it like a roundingness. That is the slowing down of the reverse repo market because of either one of two things. Either one, there's more demand for treasuries, or number two, there's just not as many treasuries being sold. So, federal government spending is starting to slow down a little bit. Maybe a combination of both of them, right? But anyways, liquidity issues in the treasury market is actually what was originally driving the reverse repo market down, because there wasn't enough buyers for the amount of treasuries that were being pushed into the financial markets. And so since there wasn't enough demand, of course, the Federal Reserve basically took this, or the system itself took this big giant piggy bank and basically sucked it out. It was a way to monetize the debt coming from the federal government here in the United States. All right, so where does that leave us on things? So down here, I've got a time cycle for all of you guys that aren't familiar with time cycles. Basically, you kind of grab them. You typically try to grab them at like big major turns. So you can see here, this is kind of our bottom. And then of course you go through these cycles, right? And then you've got a mini cycle within each cycle, but you try to grab these big giant cycles, right? And you can see here, very little pullback on this one when the market wanted to naturally pull back down here. And this is when the reverse repo market started to step in and just push everything up artificially. That's why it didn't feel so normal if you were trading back then. And the market just kind of kept going up northways, right? And then you can see the cycle kind of start stepping in to where its natural cycle was here, because the reverse repo market wasn't pumping it up. And I'm just kind of walking through this so that way we can get to where we are in today, right? And then, of course, the reverse repo market super drains, right? Just constantly draining down. We hit our peak. And then, of course, at the same time, we have the reduction in our long-term interest rates and stuff like that. So that kind of give us a little bit of a bonus for that. And it looked like the Fed was starting to signal that they were going to start easing. So that, of course, is very, very bullish for stocks. So you kind of get both, right? You get this big, massive drain in the reverse repo market, and you get them saying, "Hey, look, we're going to start cutting rates soon." So yeah, big, big bonus for the stock market. Now, where does that leave us now, right? Well, the reverse repo market still has coin in it, right? There is still some money in the reverse repo market. So if there's still money in the reverse repo market, that means this can continue to push higher. On a time cycle basis, we are hitting the last end of our large cycle and our small cycle all at the same time. You can see some of my little drawings up here. When we zoom in, you'll kind of see where I'm at. Um, as far as like the adapt advance, this is where I'm at as far as orange. But and then all these reds and greens are targets that we've made along the way. So I'll zoom in a little bit more and I'll go into like a 1 hour time frame so that way we can see basically what's going on. Oh, nope. All right. Now that I've zoomed in a little bit, you can kind of see just in general here how tight some things are. So we've got some cup targets and stuff like that that are pointing down here to the downside. We really haven't finished off a cup target to the downside, except for maybe like right here. And we turn that into some red. So you can see here on the kind of downside, if we were to break lower, this is probably where we'd be going. And this makes a lot of sense. We've got a gap back here. There's a volume range right here. There's a big snap of gap right here. And the volume, it would just make sense that we'd land somewhere around here. Now we're hitting this kind of congestion zone. Well, we've got three targets that all basically coincided with this one spot. So there's going to be congestion when that happens. This on top of a longer term channel that we had here, a little bit of a shorter term channel, and then we have a Wyckoff weakness line that's going across here where we kind of broke the bottom side of this channel or are at least getting squeezed up here, right? So I had four different situations kind of playing through as far as when I originally started the adapt advanced trade, but basically sideways and then kind of a rollover, right? Which would make sense with the time cycle. A continued push higher because the reverse repo market just continues to drain, or a kind of a more immediate pullback where we kind of start to roll over immediately because the demand for bonds was a little bit higher and you get capital flows out of there and it would push us down. So where are we at? We're kind of actually pushing towards one of my situations where the reverse repo market just continues to drain and we just kind of grind higher. But also at the same time, we've had a lot of chop recently. Now, this was all around CPI, which happened to come in just a little bit over quote unquote street expectations. But we know that CPI was going to kind of hang higher for longer. And then it looks like CPI is actually going to reaccelerate in the later half of this year. And so that should be somewhat problematic for markets as interest rates kind of rekindle their fire and everything kind of goes back up. And then the Feds basically got to really step on the brakes. And then that should kind of create an actual recession here. No more of this little footing around, right? Okay. So where are we at right now? Like I said, grinding higher. Reverse repo market still draining. There's still lots left in the tank. Remember when we zoom out here, you can see where we are on the cycle, right? Down and down. We're basically on the last end of these cycles. So there's a little bit more downside pressure. So we're kind of seeing that. But this artificially inflated environment is there. So let's wrap this into like Sleep Well portfolio and what the Sleep Well portfolio looks at. So if we go over here to our Sleep Well portfolio assets, and let's just kind of look across here. Here's a beautiful view of an inverse reverse repo market. Basically, when the reverse repo market drains, you can see how much pressure it has on the S&P 500. So that's what's been pushing this up. It's asset inflation, right? And of course, when the reverse repo market's going down, it creates and it was filling up, right? When the reverse repo market was filling up, liquidity was drying up, especially when they were tightening, right? So you can see this net effect, right? This is the macroeconomics behind the markets. And this is, it tells a very clear story, right? Then, of course, you've got the Federal Reserve that's tightening in the background, but they're like pseudo tightening, right? Like they're rolling off their balance sheet, but at the same time, the reverse repo market is absorbing all of that, right? Because it's money they've already printed previously. So as far as our assets go, let me just put them all up here. So we've got the S&P 500, we've got the dollar, we've got emerging markets, gold, IWM, and TLT in here. 1, 2, 3, 4, 5. Yes. Okay. So these are our 5 assets. Ooh, let me get rid of the reverse repo market back there. These are our 5 assets that we work on in the Sleep Well portfolio here. And also in the A.W.A.K.E. Of course, the A.W.A.K.E. is augmented. So it's got like a leverage element and it's got extra calculations on it to try to catch turns better, things like that. Albeit that has not been so great this year, it'll still work out like it normally does later on because it's got a lot of leverage, so it can actually surpass the Sleep Well portfolio. But the Sleep Well portfolio has been the large winner, and those of you guys that have been emailing me that use the leverage under high water as like a bonus on top of the Sleep Well portfolio, I know you guys have been doing awesome this year. Everyone's at the new highs. Everyone's doing fantastic. So it's always good to hear those. Thanks for sending me those emails. All right. As we look here, the S&P is definitely the large winner. I mean, if we go from the very, very bottom here, we can really clearly see where the money's been pumped into, right? As the asset inflation has kicked in, gold has done very well since the bottom, right? And then if we go all the way to, where was it, April, right? This is where the reverse repo market really started to drain, right? So April, May, somewhere around here, right? It goes definitely into risk assets. Number one, boom, here goes risk assets, right? The S&P 500, IWM to a certain extent, although the S&P 500 benefits a lot better just because growth stocks actually still have a headwind to them with high interest rates, right? And then you've got gold, which has been inflated. You've got EEM, which has been not as has not benefited as much because it's not inside the U.S. and the U.S. has been the one that's monetizing the debt. So this gives you a really clear view of really how much actual growth has been out there. You know, maybe about 7% globally or so. Now, I know this is emerging markets, so it's not perfect, but versus a country that is monetizing their own debt, printing money, and has the reserve currency that can print up their assets, right? So this is really, really indicative of how much of a bonus it is for U.S. assets. Then, of course, the dollar's actually gained a little bit of strength just because we were still tightening interest rates along the way, and typically tightening interest rates, tightening monetary policy typically is a bonus to the currency. So yet again, reserve currency bonuses. And then, of course, we've got bonds down here, which are basically they were crushed early on in the year. I mean, my gosh. I think if we go back from the beginning of the recession, TLT, which is an ETF that follows the 20-year bond, you can see that thing got just annihilated, right? It was all the way down here, 40% down? Yeah, super annihilated. We weren't in any part of that thing, thank God. So, but of course, it's part of the calculations. It's part of the data. It's part of just how the macros move, right? You don't take your risk in an asset that's not going to do well macroeconomically. So a lot of the time we were in gold and the dollar. So here's the dollar, and then gold was over here too, right? We were in the dollar for a lot of this, and then eventually we started getting dabbling into gold and the dollar, and then we have a little bit of gold through this as far as here. So you can see here with the assets that you have in the Sleep Well portfolio, in general, they are everything is performing very well. That's why we're up at new highs. Everything's been enjoying that. We do have quite a bit in the S&P 500, not a lot in IWM. Yet again, I just kind of reiterate that growth stocks have a little bit more of a headwind, so we don't get as much of an allocation to them. But in pullbacks, we can actually get a little bit of an allocation to them if they provide some extra value. Gold will definitely be a strong part of the portfolio, but the way that the Sleep Well works versus the A.W.A.K.E. is the Sleep Well it is much more sensitive to relative price over the short term. And so it wants to actually see a little bit of a pullback in here along with the macros. So think of it like kind of like a mean reversion type of uh, bonus on top of a macro portfolio, right? So there you go. So we're waiting for that. And that just deals with like fractal calculations, right? And then emerging markets will definitely play a role at some point, especially as the Fed attempts to ease, although it's looking like they're not going to be able to as much as they hoped. So there will be some rate cuts being taken out of it. All right, so that is it for the Sleep Well portfolio. So if that's what you were here for, that's wrapped up. Now we're going to dig into just the rest of, interest rates, and then we're going to look at concentration. So interest rates. Well, over here at the Fed Watch tool, which is a great tool, by the way, if you guys ever want to, cmegroup.com, and you just go to the interest rates Fed Watch tool. This is fantastic. So you can see here, basically, we're not dropping interest rates in March. No one expects it to. So basically what we're looking for is what are they saying for the rest of the year? And with interest rates holding steady, or not interest rates, but inflation rates holding steady, we can see that here on the 12-month right here. So our inflation kind of holding steady on a somewhat positive mode. I guess I can say that the all items less food and energy, which is kind of more core inflation, is slightly ticking down, but not nearly as much as where the Fed really likes it. The Fed likes it to hover around this 2%, and we are still far above and beyond where they want that to be. So they're going to probably hold up for longer and be stronger, right, type of thing. So as far as the market is actually starting to price in just a little bit of a probability of a rate cut in May, but most likely not. And then June is our first rate cut, apparently. Now, even with a rate cut in June, we go down 0.25% and stay there, right? It's really, we're not cutting much more. Mostly we're still in this. And then finally we get another rate cut in September, and then another rate cut in November, right? So 450. And then our center point is kind of more here, but even still, it's not perfect, right? The market is slowly but surely realizing that this inflation thing is going to stick around for a lot longer. So that really doesn't bring the front end of the yield curve down much, right? So it's not going to be as big of a bonus as everyone thinks, and the back end of the yield curve might actually lift up just a little bit because that inflation is going to stick around for a little bit longer than everyone thought as we quote unquote try to do this soft landing. All right, so concentration. Everyone's kind of asking me, well, I shouldn't say everyone, but I wrote an article on our website over here at etradingedge.com about the concentration effect, right? And it's in our blog, so you can actually get to our blog down here, Trading Education down here in our footer. And so I talked about the concentration, and I'll pull it up really quick. Yeah, so here's the concentration effect. So anyway, so I talked about this concentration effect and its implications. And really what I was talking about here is that when we look at the top, let's just take the top 5 companies, right? So we're going to look at the top 5 companies in the S&P 500. And this is the SPY, so not to get like too into like the minutia here, but like the point is that the concentration of the SPY is very similar to the S&P 500 index itself because they have to reflect each other. So but Microsoft itself is 7%. Man, 7% of it. I mean, that's massive for a single company, right? Then Apple, which is almost 6%. Then NVIDIA, which is 5, right? 3, right? 2.5, right? So if we sit there and we take that, that's 20, just about 24% in the top 5 companies, right? That is a massive, massive concentration. Then on top of that, take into account that all top 5 companies, they're all tech. They're all tech companies, right? And then if we go down one more to get over 25, we've got Alphabet, which is also a tech company. Then right below that is Berkshire, which is basically just a derivative of the stock market because it's just mostly a stock holdings company, right? So if you think about that, we have a massive amount of the S&P 500, more so than we've pretty much ever had in history, except in other large, crazy bubbles. And this is definitely a bubble, right? This is the, you know, government monetization debt bubble, like whatever we want to call it at the end, right? But it's definitely a bubble. It's an asset bubble. And it's awesome, but at the same time, we have to keep in mind how this is starting to affect changes in things. So if we jump back over here to the SPX, and we'll go. Let's jump back up here to this graph. So if we look at the SPX, you're starting to see something that we don't normally see in indexes, or we never saw really much in history. And that is this net effect of large gaps, right? So if we go back to, let's just call it like 2013 and jazz, and we'll just zoom in here, and we're on a 1-day chart. So let me just zoom in here. And you can see here as it's as it's trending and chopping and doing this. And this is another asset bubble, by the way. This is when the quantitative easing, like the original quantitative easing, which we are quantitative easing right now. It's just not being called that, right? So keep in mind, like they are definitely pumping money into markets, into the treasury market, just like they were doing back here in 2013. But you can see here, in general, we don't have any large gaps in here, right? Everything's and you can almost see that there's a consistency behind the market. There's a couple little, relative, accelerations at the top end of a range. Here's another one where acceleration at the top end of a range. But it's kind of, it's an asset bubble, right? You can kind of see that it's being pushed up, but you don't see any huge major gaps in here, right? And then, of course, pre this, when there was no quantitative easing there for a little while, you can see very orderly, I would say, no gaps, no big anything. Of course, you had the debt crisis. That was when we turned off quantitative easing from this little spigot, right? So you can see every time the Fed injects money into the treasury market, it kind of just goes up without ever stopping, right? It's an unnatural force pushing the market up. And then when that stops, it just, goes through this little wreck spiel. We had flash crash. That was yet again another stopping point where they stopped quantitative easing and the market freaked out for a little while, right? So anyways, even in 2008, right, we don't see any very large gaps. I mean, we had one large gap right there. That's, of course, in the massive major of the crash, right? Here's another one, right? Those are super crash time periods, but I mean, nothing up here. Everything was fine. So, okay, let's go all the way. We're just going to zoom all the way to where we are now. I'm going to have to rescale this. And then just check this out, right? Like as this concentration effect started to take place, gap, 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 gap right here. Look at that thing. I mean, there was just in a week time, a gap down and then a gap up. And then this was an NVIDIA earnings announcement, right? So these are things that are starting to happen in the markets that typically didn't happen before. And it's because we're so concentrated. We're so top heavy in the top 5 companies, right? And so anything that those top 5 companies do will definitely swing the markets around. And you kind of add that with the technology that we have, which everyone can be a trader, everyone can basically buy and sell shares. And these ETFs are making it easier for indexes to be bought and sold basically instantaneously. It is really starting to have almost like a stock effect on what used to be a very diversified asset and is now being significantly more acting, or is now significantly acting more like a stock. So just keep that in mind as we're trading, right? I know in the Adapt Advance, we definitely keep it in mind, and it changes some things. And it's definitely something to be said that the power of the reverse repo market and the amount of printing that's happening and the monetization of debt, you cannot take that for granted. It is amazing how much it will pump markets up. But as we've also seen in history, when the Federal Reserve and the financial markets in general stop the quantitative easing, we have corrections. We have corrections. We have corrections, right? This is very, very normal, right? We have, here's the not QE starting up in the September whenever they blew up the repo market originally, right? So anytime the Federal Reserve is printing money, I mean, the market just goes up, right? Go long and strong. So keep that in mind. We're going to be watching the reverse repo market. We're going to be watching other macro indicators, things like that. But that's why the Sleep Well portfolio is hitting new highs. That's why market's hitting new highs. Enjoy it. Make some money. Print. Enjoy it. And just watch out for the downside when the spigot gets turned off. And, I'll let you know when it does as far as my measurements go. All right, guys. I'll talk to you next time.